All right, guys, let's get into this.
Before we talk about your business, I want to talk more big picture about the conversation here in Sun Valley, specifically about the...
Wait a minute. I already don't like something. What is it I don't like? Come on, Anthony Noto. Where's the Nikes at, man? He's wearing those ons.
Economy, given your purview through your business, as well as the conversations you've been having with other CEOs, what's your sense of the economy right now?
Yeah, I'd say the conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We've came into that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people will believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, but not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive. As it relates to the consumer, we've seen really good trends in spending. We've seen really strong demand for refinancing personal loans as people are trying to lower their debt so they can make sure they're planning for the future. So overall, our company's performed really well in this environment. I'm glad we took the stance of lower rate cuts than everyone else because it's positioned us now to benefit when rates start to come down. So I like how we're positioned. And for the first time, I'd say in 2 years, there's a more central consensus view about rates and where credit is. And credit actually has performed relatively well throughout the year. And that's something I heard from a couple CEOs last night. And we're really happy with where it's performed as well, in line with our tolerance levels and our expectations. So all in all, I think we're setting up for a pretty strong back half of the year in 2025 if we get the right fiscal policy.
Well, we're going to talk.
Okay, so confident. I like that. He did kind of leave himself a little scapegoat there at the end, as long as the fiscal policy's right? Which it sounds like he really wants, at least 1 to 2 rate cuts this year. He also mentions, specifically, I think it's very important here. He mentions we're off to a good start this quarter.
Conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then.
We're really pleased, that's where these little sneaky things here that you can miss over, right? We're really pleased with how things have gone since then, right? I think that's an important statement.
Business, which is a really strong quarter, and we're really pleased with how things have gone since then.
We're really pleased with how things have gone since then. I think that's really important right there, right? So definitely good to hear overall. And the lending business, it's tough. It's banking, right? And it must be done. Otherwise, how are you going to have a banking business if you don't lend? But at the same time, there's always that risk whenever you're a lender in the market, right? Of like, well, what happens if recession happens and people don't pay and all those sorts of things. So are things to be considered.
You mentioned you're not doing as many student loans. What is behind that policy, and where are you shifting your focus to effectively follow or lead consumers, and where you want to be growing the business?
Sure. As we came into 2024, there was a view that actually rates would be cut 4 or 5 times. And we believed that for rates to be cut that frequently, there would have to be a recession or some type of underlying problem. It turns out we'll get 1 to 2 rate cuts, which is where we've been positioned. And as we thought about the environment and thought about how much we invested in our financial services business, our SoFi Money product, our SoFi Invest product, our credit card product, as well as our technology platform, we had an opportunity to drive really strong growth there at 50% and really pull back in the lending business to be more conservative, to wait to see where the economy shakes out, where interest rates shake out. And now we're coming into a picture where that's a lot clearer. So we've delivered really strong growth without really using the lending business to help drive it. And now we're in a position where, as we go into 2025, to use both.
Now, of course, your business all started with student loans. And then just last week, a federal appeals court allowed a key part of Biden's student loan repayment plan to resume, staying in an order that had temporarily blocked it. Now, there's been a lot of back and forth on this. But how does Biden's efforts to repay student loans impact your business? And how?
Now, very important. Remember what they're talking about right here. Remember what's been going on with all the student loan drama, right? Remember how that's hurt SoFi. And then remember all that when we come to the portion where it talks about who would you rather favor to be in the White House. So keep all that in mind.
To see some of these legal changes and sort of the whole appeals process and the outcomes impacting your business going forward.
Yeah, we've really focused on people that have private student loans. Those are people that are still managing their cost and giving them cost savings on refinancing their private student loans, and that's been a smart strategy. It's a much smaller percent of our business. We gave guidance that we'll do close to $2.5 billion of revenue this year. We'll see really strong growth from the other businesses, so we're much less dependent on it. The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing for consumers in our SoFi Money product with 4.6% interest rate, SoFi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political or winds are blowing as relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a refinancing business. We've invested a lot in being able to do purchase home loans, and we're now seeing that pick up and gaining market share there. And we've recently made the decision on home equity lines to give people even lower costs of debt. So as rates come down, we'll see a real pickup, and as long as the economy is stable and inflation is stable.
So you've mentioned various ways that your business is growing, but your stock is way down. Stock's down about 35% year to date, down about 19% since your last earnings report. I know that you have earnings coming up in a few weeks, so you're limited in terms of how many specifics you can share. But what's your message to investors? Why should they hold on when the stock is down so dramatically?
Yeah. The thing that we can control is our strategy and our execution. And for the last 7.5 years, our strategy has been consistent and our execution has been consistent. We've driven good, steady growth. When I joined the company, we had less than $300 million of revenue in 2018. Now we're over $2 billion of revenue. We weren't generating profits. We weren't generating positive EBITDA. Now we're generating both positive EBITDA and GAAP profitability.
Boom.
So I'm really pleased with what we're doing. In terms of the stock, I'm equally disappointed. I'm a big investor. Our employees are large investors. What we've seen and what we believe is happening is that the group of fintech companies that have credit exposure has been really hit hard, and they've been hit hard because of the uncertainty around interest rates. When will interest rates peak, and when will credit peak? And as I mentioned, we're really pleased with where credit's performed. We expected it to pick up a little bit, but it's within our tolerance levels, so a good sign there. And as I mentioned, 1 to 2 rate cuts would be welcomed and moving in the right direction.
And what about AI? Well,
So I think the important thing to understand about what's going on with SoFi's stock price is if we don't get any major recession in the next year or two, what's going on with SoFi stock is absolutely ridiculous. It's a steal deal, and the stock will go to, $18, $20, $22 a share. If we get that big recession in the next year or two, this all makes sense. You could understand why it went down to $6, right? If that big recession hits, we get a big unemployment cycle. If credit delinquencies go up in a substantial way, people's credits drop in general in a substantial way, right? Then it all makes sense. And it's like, oh yeah, we get it. Like that made sense to put SoFi down to 6 because the market was pricing in bad stuff that was going to happen in the economy. So that's the way I would look at it is, yeah, big recession, this all makes sense. Not a big recession, then this is absolutely silly to be pricing SoFi at $6 a share.
The one to bring AI to retail banking, and will that really accelerate your results?
Yeah, there's a whole spectrum of technologies that we use every day to ensure that our product is safe, it's reliable, and we can be a trusted partner. Where we want to use AI is to fortify those areas, but we also want to use it to answer 3 questions every day. Because this is a financial show and we operate in a financial world, people want to talk about interest rates and consumer spending. We don't spend a ton of time talking about the product, but we are a product company, and my vision for the product is that you open up SoFi every day and you go to your member home feed just like you would to your Twitter home feed or your Facebook home feed or LinkedIn home feed, but we answer 3 questions for you in a personalized way. What must you do in your financial life that day? What should you do and what can you do? AI allows us to take all the data.
That's awesome, Anthony Noto. Awesome. But 90% plus the population doesn't give a crap about that. If you think they're going to log in to see what they can do that day on when it comes to their money, I wish it was like that. I really do. I really do. But it's not. They would much rather watch TikTok. They would much rather watch Instagram. They would much rather go on X and surf around. That's what, this is just humans we're talking about here. I wish they really cared about their money like that, but they don't. Let's just call it what it is. We can act like it's going to be this way or that way, and it would be sweet. Wish it was like that, but it's not. And that's unfortunate.
You and everyone else, and answer those 3 questions.
Just a final question about politics, because I know the conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular?
Looks beautiful. I just want to run through those fields right now.
Well, I'll make an analogy. I went to West Point and I played football, and I want Navy to win 364 days of the year. But on that one day when they play Army, I want Army to win. And so I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
So, who did Anthony Noto just say he's voting for? Who he wants to win the election? Well, it's very clear. He wants it to be a red show, right? So, does it come as a surprise to me that he would come out and say that? Not really. Not really. I mean, listen, look what's happened with the student loans and the forgiveness and the forbearance and all that, and then dragging on and on and on. And look at how that, hurt SoFi's business model, the stock price, a lot of different things, right? And look at, inflation. So a lot of people, aren't happy with the current situation and kind of how the country's been run recently. And so does it surprise me that he comes out and says something like that? No, it doesn't. Is Anthony Noto a Democrat at heart? I don't know. I have no clue. He might be a liberal. He might always be a Republican. I don't know. But I understand his point there, right? So it doesn't surprise me. If anybody was surprised by him coming out and saying that, let me know in the comments. I'm actually not surprised, really. How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Liz Young, it's time to take some gains in large cap.
Before that September meeting.
And once again, like I mentioned at the beginning of this video, very important. If you listen to Liz Young's tone, it's definitely been more of a bearish tone for 2+ years now. So keep that in mind, because it's important you understand kind of where a person's stance has been overall for the last couple of years.
After this week, we're going to get 2 more CPI prints before that September meeting. So the August pause builds in an opportunity for them to stay flexible. I think what happened today was, we didn't see the futures market move too much on what it was expecting in July or September. But I think if we get a cooler print on CPI this week, and if we get a cooler print on PPI, September will get priced in as a lock.
Okay, so what does that mean for me preparing for that as an investor? What do I do?
Well, I still think there's a contradiction. It seems like the market continues to cheer cooler data as long as earnings are strong. And that's okay, but as soon as we start cheering cooler data that sometime will catch up with earnings, I think the market's going to have to digest at what point is cool too cool.
Well, that's what Goldman was talking about today, right? I don't know if you saw that blurb from them. The idea that bad news is eventually going to be bad news for the market. Or at least it could be.
Well, and there's been sort of this detachment. We want the economic data to get cooler, but earnings data needs to stay strong.
There you go. We're showing it on the screen right now.
And it continues to be that way. And I think this quarter probably continues to be that way as well. When we get cooler data in the economy, it confirms that the Fed can start cutting rates in September, and stocks will cheer that. But some of the things that I look at that are a little bit concerning about it is that even if we compare it to the mid-90s and say, okay, the Fed started cutting rates, everything was fine, we secured a soft landing. They started cutting rates at a point when the unemployment rate was 5.6% and falling. So they cut rates at that point into a strengthening labor market. At this point, we just crossed above 4% in unemployment. We've gone up for the last 3 months in a row. It will likely continue to weaken. None of these numbers are concerning, but it will likely continue to weaken, and then the Fed will be cutting into a weakening labor market.
Sure,
the market has to understand.
Yes, okay, but weakening from a high level.
From a tight spot.
So
yes.
That's what the Fed chair said today, right? Yes, the labor market's cooled, but it's still strong, right? He used the word strong. It's back in balance, is the labor market. It's not like it's falling apart.
Correct.
It's just slowing.
Right. And his
Which
idea
is kind of what they need.
Yes, right now.
In some respects.
In this present moment right now, that is exactly what they need. And being back in balance is referencing more how many jobs are open versus how many people are unemployed in order to fill those jobs. We were way too tight before, driving wage costs up, and we all know that that put pressure on earnings in companies. The issue is that if you look over history, the longest history you can find of an unemployment rate, as it starts to rise, it hits escape velocity quickly, and it's difficult to stop that rise. The rises usually happen very fast. So right now, we're still in a good sweet spot. Between 4 and 4.5%, I would call the sweet spot of the unemployment rate.
I agree with that.
Because 4.5% is still what's considered frictional unemployment, what we can expect even in a healthy economy. So that's okay. What we need to not happen is that the speed picks up. If the speed picks up and we can't get a hold of it while the Fed is cutting rates, then it'll look like they're reacting to something that's getting weaker.
Okay, so maybe the most...
So how do I feel about taking gains in large caps? So if you're on margin, which you shouldn't be, but if you are on margin, I could definitely understand taking some gains in large caps over this next, I would say, 30 to 60 days. Margin is not something to play with in general, and especially after a run like this we've had in large cap, which is really, we're about a year and 3/4 of a run now at this point in time, right? Once we reach October, if the run still goes into October, right, that's going to be 2 years straight run, really in large cap and large cap tech specifically, right? So yeah, but on the flip side, if you're a long-term investor, you just ride the waves, man. Ride the waves. It's impossible to kind of time out the market and say, I'm going to get out, and I'll get back in, and I'll get out, get out. No, we don't play that game. We don't play that game. That makes for worse returns over time.
Debatable idea you have that we can kick back and forth is this idea of a portfolio move to make right now. Trim some gains, particularly in large caps that are driving the market. You're talking about mega caps. Okay, and allocate to sectors that benefit from steepening yield curve. We can go through what those are, but
sure.
You really want to take some profits off the table. I know you're smiling because it's like a gutsy call, right?
Yeah.
I mean, it's some people are going to say, no way.
Yeah.
Why do you want to do it?
So whenever the market gets to extremes, it's at a higher risk of what I'll call normalization. I'm not even going to say mean reversion. I'll say normalization. Some of the metrics that are getting uncomfortably extreme right now are things like the forward PE ratio on the S&P is in the 89th percentile. The spread between the market cap weighted S&P and the equal weighted S&P over 1 year is 17%. That's in the 99th percentile. And then we've got the max drawdown this year so far, only 5%. If we hold that, that's in the 91st percentile. So we are getting to the point of extremes, just in the sense of, okay, is it time for there to be what I would call a redistribution of strength? Okay, that doesn't mean that we have to have this big pullback, but when you get certain pockets of the market that are so overly valued compared to others, there might need to be a redistribution. Some people might call that a broadening.
Okay, well, that's what I'm going with, though, because can you get the broadening? Do you think there's going to be I'll use your words, a redistribution of strength at the same time where you appear to have some growing concerns about the strength of the economy. Do I want to buy into your broadening story at the same time I buy into your weakening story? How do I do that?
So, good question. The broadening story that we've seen so many times has been a broadening into cyclicals, a broadening into small caps. What I would consider a broadening now is a broadening into those sectors that would do well, that tend to do well in a steepening yield curve environment, which is what I expect to happen in the second half if and when the Fed starts cutting rates. We'll see the 2-year
banks,
come down. Some of it is financials. As the yield curve steepens, yes, financials should benefit from that. But the ones that tend to do well in a prolonged steepening environment are things like energy, stocks that are paying a good dividend, and then staples, utilities, healthcare. I'll put a little asterisk by healthcare because of the election, but those are the sectors that tend to do well. And that's not even a defensive statement. That's more of a dividend statement, and the ones that are not the high flyers that have benefited from what we've seen in rallies recently.
So definitely, so first off, I disagree with her whole notion of like this kind of trading in and out, and we got to position into these stocks, and then we got to position out of these stocks. No, okay. Secondly, if you think the economy is going to get hit in any substantial way, and if you think the market's going to get hit in any substantial way, just understand there's not really anywhere to hide in that situation. When the market gets hit, everything gets hit. And that means even your dividend payers, Johnson & Johnson, Procter & Gamble, Kimberly-Clark, all those guys, go back to the great financial crisis. You'll see all those stocks were public companies back then. They all got hit. Coca-Cola, Pepsi. Maybe they didn't get hit as hard, but if you were in the camp of things going bad, well, you might as well just not have money invested at that particular time. If you're really 100% convinced that's going to be the situation that plays out, which never be 100% convinced anything's going to play out in the market, because just when you're 100% convinced, the opposite usually happens, right? So that I just don't agree with. At the end of the day, when you're presented with opportunities where countless stocks are really getting hammered, and there's that opportunity, you got to take advantage. And so right now, for this back half of the year, we're going to have this extraordinary opportunity for a lot of these great consumer companies, and you're going to have your pick of everything. And most of these stocks will be money makers come 2, 3, 4, 5, 6 years from now, right? And so whether you want to buy a McDonald's or a Starbucks or a Nike or a Wynn, or there's just a platter, an Estee Lauder, a platter of these stocks that are already significantly discounted and probably will continue to be discounted for at least the next few months. And you got to take advantage of that, right? You got to take advantage of that opportunity, because what we're seeing in these consumer-related stocks is the same thing we watched play out in big tech, right? It's the same exact game, actually, where big tech was just getting absolutely obliterated in 2022. And no one wanted a piece. It seemed like no one wanted a piece of any tech-related stock. Look, they all did horrible, right? Some did way worse than others. Meta was down like 70%, right? Whereas Apple only fell, 20-something%, peak to trough in that situation. Microsoft might have been down 30%-ish, right? Some got hit a lot harder than others. Shopify was down peak to trough. I think Shopify was down like 80%. Netflix got destroyed. Nvidia was down 50%. Remember that? And so you got this platter of here you go. All these great tech stocks are right here for you. Buy what you want, right? And some people said, no, I don't want a piece of any of these. And every single person that said that, all regret it. They all regret it. They're probably so jaded that they probably left the market and never want to touch the market again, because they're probably so jaded by the situation. And so now, here's our platter. Here's our buffet of consumer stocks. All the best consumer companies over the past 10, 20 years are all trading at these insane discounts. And you've got a platter in front of you. And are you going to take advantage? Are you going to grab what you can grab? Or are you going to say, no, maybe a year from now, maybe 2 years from now, I'll buy that. And then you're going to look back and be like, dang, I had a chance to buy that stock, 40% lows, 50% lows, 5-year lows, 6-year lows, 7-year lows. And I chose not to buy those stocks. And I think a lot of people are going to look back with a lot of regret. I think other people are going to look back and be like, thank goodness I took advantage of all those deals we got in that second half of 2024. Because there's going to be a lot of great deals, right?